I'm a little surprised, frankly, that gold prices are as low as they are. I don't know where the gold price is going to go. Will it overshoot to the upside before settling out to mean? Likely. Will it actually revert to mean? Not exactly. I am also a holder of liquidity in gold. But if you are going to be a holder of liquidity in gold, you have to be psychologically willing to sell it.
Way ahead just by holding gold, which pays no interest and earns nothing but dust sitting in a safe. So the point of it is that the exercise in precious metals is one of preservation. And it's not about getting wealthy. It is wealth, but it is wealth that has a way of keeping up with the debasement of the currencies around us. For the past 25 years, the average annual return is between 8 and 11% across the board in all the major currencies. So, it's sometimes return on your money is not really as great as return of your money. And I think that's what we're trying to talk about with gold.
In this episode, we've curated the finest moments from financial experts Andy Schectman and Rick Rule, condensing hours of their insights so you don't have to watch hours and hours of footage. Andy sheds light on the current dynamics at the COMEX exchange, where Shanghai is accepting physical deliveries and marking them up at a premium. Meanwhile, Rick Rule discusses the strategy of liquidating your gold and silver assets to build a cash reserve in the event of an unforeseen major crisis. If you're a gold and silver enthusiast, this video is tailor-made for you. Don't forget to like, subscribe, and activate notifications to stay updated with our daily market summaries and top clips from the most in-demand commodity experts. Enjoy the episode.
Times when there isn't liquidity gives me the tools and hopefully the courage to take advantage of illiquid situations rather than being taken advantage of or by them. I do not make long-term investments in the US dollar. I'm not a holder of treasuries with a date longer than 2 years. I invest in things where time is on my side, and the dollar is not one of those. But I certainly am a holder of US dollar liquidity because I suspect that the things I'd like to buy in a panic will be denominated in dollars. I am also a holder of liquidity in gold. But if you are going to be a holder of liquidity in gold, you have to be psychologically willing to sell it. I remember very well in a couple prior panics, clients of mine who had large gold holdings were unwilling to sell it, to use the stored wealth in gold to diversify into asset classes that stood a better chance of performing in the panic. So for those people, their gold wasn't liquidity, particularly in 2008, when, as a consequence of illiquidity, the gold quote fell too. So it's important that if you hold gold for liquidity, which I do, that you maintain the psychological predisposition to be able to sell it, to use some of it to acquire other asset classes that you think will perform better for you.
If you would have bought, let's go back to 2019 and any time before that, you go back most of my career, the U.S. Mint has been pretty static at their prices. And so, you would pay, let's call it $339 to $359 over spot to buy Silver Eagles most of my career. And most of my career, I would have bought them back from you for between $265 and $285 over spot. That would have been the buyback. So you were talking, a difference in price between 60 and 80 cents bid ask. So let's say someone called and asked you that question and say, hey, I want Slayer, I want to buy 3 mint boxes. And this was, let's just say we had this relationship way back when, and Thanksgiving Day, 2019, you're just about ready to go have, Thanksgiving dinner with your family, and the phone rings and it's one of your good clients says, hey man, hook me up. By the way, what will you sell them to me for? You say $339. Great. What will you buy them back for? $265. Great. Lock it in. Calls you back 5 months later in the middle of COVID and says, hey, dude, I need to sell. My business got shut down. It's non-essential. It's not a dispensary or a liquor store. So I need to get some money. Could you buy it back? And you told me $265 over. Are you still good with that? And the answer would have been, no, I can't give you $265, but how about $11 over? Because the premiums are not just a function, as they always were most of my career, of production and distribution, where the mint takes a blank piece of silver or gold and turns it into a coin, puts it in tubes of 20 and boxes of 500 and sends it out to the public. But it's become, over the last several years, more a function of that plus supply and demand, or the lack thereof. And when you look at how poor the U.S. Mint has been at keeping up with demand, they are the model of inefficiency, really. Premiums can go way higher. So when you quote a premium now, it's today, it's at one point in a circle. But who's to say what tomorrow may bring? And I have a feeling with the less than 0.5% ownership in metals in the United States, that something over the next several months probably will trigger people's mentality to look at things a little bit differently. Unconventional times call for unconventional thought, and these are anything but normal. So yeah, we will always buy it back, and premiums will fluctuate. And if there's far more demand than there is supply, the buyback premiums will be at markedly higher. And if it's the other way around, they'll be lower. So, but we will always be at the very top of the buyback list, and it's important to us to always provide that two-way market.
Because people don't trust each other. You need a medium of exchange that's globally accepted. The dollar is that. I have, from a prior life, a lot of experience with sovereign wealth funds. And I remember conversations with a couple of Asian sovereign wealth funds asking them whether they actually trusted the U.S. government. And they said, of course not, but we trust them more than we trust each other. Some would argue that Bitcoin, as an example, could function as a global medium of exchange. My suspicion is that the float, pick a price, is too small, and that global adoption, is too far away. Others suggest that the BRICS could become the global reserve currency. The trouble is that none of the underlying currencies that would form the BRICS are convertible. So that's a bit of a problem. And as little as those countries trust us, they trust each other less. Can you imagine what the Chinese would feel like if they developed a treasury chest of a couple billion or trillion euros, or not euros, I'm sorry, rubles, and they went to Russia to cash in? That doesn't work. I'm 71 years of age, and I suspect that for the balance of my lifetime, and I intend to live a long time, that the dollar will still be the world's reserve currency, albeit not as dominant as it has been.
In the continuation of the episode, Rick Rule, a financial expert, talks about the future of gold. He believes that gold prices will not go down unless three big changes happen. The government balances its budget, interest rates go up, and the government stops increasing the money supply. Without these changes, Rick thinks gold will stay valuable for many years. He feels confident because these economic conditions are not likely to happen soon. In his discussion, Rick shares some smart investment tips. He likes to invest in things that are very important but not expensive right now, like natural gas and lithium. These resources are crucial for our daily life and the future of technology, especially as we move towards using more green energy and electric vehicles. Rick explains that when things are cheap, not many people want them, but eventually they become valuable as they become rarer. Rick also talks about how markets behave. He says that if something is priced too low, it won't be available after some time because no one will make it anymore. This makes the price go up later. On the other hand, if something is too expensive, the high price will eventually come down. Rick stresses the importance of being patient and understanding these cycles in the market to make good investment decisions. Like and subscribe if you find our recaps valuable. Now let's get back into the episode.
Commodities. And when we talk about the LBMA, largely the Chinese have involved themselves in what's called exchange for physical. And usually that ends up in buying COMEX contracts and delivering them in London. But what we've seen recently is a huge amount of kilobars, I think it's called the mini contract on COMEX, that have been delivered to the Brinks facility in Hong Kong. And there is a COMEX Brinks facility that is largely only delivered into when it is exchanged for physical. And the author who talked about this very eloquently said what is happening is that they short the price of metal, they buy the physical for delivery off of COMEX into Hong Kong, COMEX Brinks facility, and then truck it to the Shanghai Gold Exchange, where it is then sold, to this mass exodus out of the Shanghai Gold Exchange, where they're delivering many times what the COMEX market does every day. And this is how countries are sidestepping sanctions. Like Iran will sell their oil to China for yuan, which is immediately convertible into gold on the Shanghai Gold Exchange. And for all we know, it's the kilo bars that left the COMEX that were delivered to the COMEX approved depository in Hong Kong, then trucked to the Shanghai Gold Exchange, and then sold to Iran as they cash in their yuan that they use to, buy oil with or sell their oil with. And this is exactly this slow process of bleeding down the exchanges. And absolutely, when you look at the LBMA, they have the lowest level of silver that they've had maybe ever in the 140-year history of the mint that isn't already encumbered, belonging to ETFs and belonging to other entities. And when you realize that Gordon Brown sold the majority of all of their gold, there's no wonder that they're saying, we'll buy it back, even if we didn't produce it. That reeks of desperation. And, so again, I don't know how much time is left in all of this. I don't know when we're going to see the big move in gold and silver that we've all been anticipating, but certainly you can see it all around us in terms of geopolitical events, political events, moral, social. And then you see a mint like this saying, we'll take anything you want to sell, even if we didn't sell it to you. And we never did this before, but we'll do it now. It just tells me that the hour is drawing nearer before we see some sort of gold revaluation. And, you keep hearing that gold revaluation. Well, look, it's ironic that the central banks hold gold in their central bank accounts in an account called the gold revaluation account. You look at their balance sheet, that's what it says, the gold revaluation account. Roosevelt did it. He confiscated gold, which I don't see them doing this time because everyone owned gold back then, not now. It was currency back then. But then he devalued the dollar by 40%, making gold, go up 40%. And you got the head of the Dutch National Bank saying the same thing. This is what we should do. And a lot of people saying this is what we will do. We will just revalue the price of gold, and that will get our balance sheet in order. One that is continually denigrating by the day to the tune of, $100,000 a second that we are adding in debt to $1 trillion every 100 days. And yet we continue to borrow money and give it to other countries like the Ukraine, $60 billion, and chastise and call names to our congressmen and women who would have the audacity to question the sanity of maybe just putting America first once. And I think this is, you put it all together, you start to see just what it is that I'm talking about. And, I hate to be this pessimistic about things, but yet the lunacy continues. And, no more so than what we saw in the Jared Bernstein interview. I hope everyone checks it out if they haven't seen it by now. But there is lunacy all around us. And most of the people watching this show probably would have a better idea of how to run the government's finances on a big picture than the people that we are putting in charge. And this is starting to have consequences around the globe, not just in the United States.
Now, Rick Rule compares the current stagflation situation with previous times in history and shares a message for gold and silver holders.
Perhaps because I lived through the decade of the 70s, and I know what inflation looks like, and I know what stagflation looks like. And I know that the only way out of the fiscal situation that confronts the United States and many other countries is the debasement of the currency. I'm surprised that it has taken as long as it has for investors to come to understand that they need to own some gold and silver. Now, the truth is that if I paid more attention to my own personal history, this would be understandable. As a high school student in 1967, I began to be aware that the debt in the United States and the deficits associated with guns and butter were unsustainable. Did I do anything about it? No, I was a high school student and I was broke. But more importantly, did investors? No. The truth was, it took until 1972 or 1973 before the ravages of inflation had caught up with individual investors. Remember that by 1970, the world had been through 25 years of pretty benign economic climb after the end of World War II. And people were accustomed to think that things got better and better and better. And they didn't pay attention to nagging little problems like debt and deficits until over 5 years, the gasoline price went from 20 cents a gallon to $1 a gallon. Until the price of a hamburger at McDonald's went from $5 to $1, which is to say 20 cents each, to 75 cents each. After 5 years, the perniciousness of inflation became apparent to people, and they began to pay attention to it. So the fact that it's taken people some time after a 40-year period of benign economic climate makes absolute sense to me when I think of it in that context. It's my belief that we have, for the purposes of this discussion, two time frames to talk about, 1982 to 2022, with U.S. dollar hegemony very strong and the interest rate, both nominal and real, falling. And then we have a sea change at the end of 2022 with the interest rate rising. That interest rate rising heralds the beginnings of a new era, one that will survive, but one that will be challenging. The circumstance that we have in front of us, the debt and deficit in the United States, we've seen before. You will not cut spending. That's not what the voters will tolerate. And you won't raise taxes too much. So how do you get out of there? Well, you debase the purchasing power of the currency. In other words, you devalue the debt that you have by printing. In the decade of the 1970s, we devalued the U.S. dollar in terms of the basket of goods and services that Americans live on by over 80%. And of course, that coincided with a meteoric rise in the gold price. The way we get out of stagflation this time is very likely the debasement of the currency that the debt is denominated in. So I think past this prologue. That's a long-winded answer by way of saying no, unless the conditions precedent for a decline in gold come to exist, which is to say a balanced budget, positive real interest rates, and the end of quantitative easing, I'm not afraid of another 15 years of stagnant gold prices.
What do you think of Schectman and Rule takes? Do you agree with them? Share your honest opinion in the comment section down below and watch this video right here because you'll love it. I see you on the other side.